let's just say that this is not a uniform problem that goes across all of corporates and SMEs.
This is a kind of a network that tries to identify solutions to tackle this trade finance gap by 2040.
We need to continue with this collaboration, with this blue sky thinking, that what is the art of the possible, and that should be possible.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance. I'm Dipesh Patel, editor at Trade Treasury Payments, and today we're bringing together some of the industry leaders who are playing a fundamental and critical role in shaping some of the systemic gaps we face in SME liquidity, trade finance, and working capital finance. And over the past year or so, we've seen the emergence of a brand new initiative, the Trade Finance Conference of the Parties, commonly known as TFCOP, which is one of the few places where multilaterals, banks, insurers, fintechs, and policymakers are coming together to confront some of these structural barriers head on that prevent capital from reaching businesses and markets that need it the most. What's becoming increasingly clear is the often debated $2.5 trillion trade finance gap is not a single problem. It's a set of deeply rooted frictions, those missing data points that make SMEs unbankable, the regulatory and capital constraints that weigh on bank balance sheets, and the domestic SME financing bottlenecks that are often larger than those cross-border challenges. And finally, the limited risk capacity, precisely in regions where demand is rising fastest. So what are the workable solutions? What are the new business models? What can we do with data, and how can we rethink trade tech? And how do we prioritize all of these solutions to address the challenges in the best way possible? So that's the backdrop for our conversation today. And I'm delighted to be joined by Makiko Toyoda, Global Manager of the Trade and Supply Chain Finance Programme at IFC, and Shona Tatchell, Director of the Trade Facilitation Programme at EBRD. Makiko, Shona, welcome to TTP.
Thanks, Dipesh. It's great to be with you, and also with Makiko. Makiko and I speak a lot. We have very similar objectives and similar programs.
Thank you, Dipesh, for the invitation. I'm very excited that I have a chance to talk to Shona on this conversation.
Brilliant. And it's great to hear, of course, I'm sure it's music to many people's ears. Multilateral development banks do collaborate and cooperate. That's really important. So Makiko, let's jump straight into it. From your perspective, what do you see as the most urgent barriers to closing that $2.5 trillion trade finance gap today? And why are they proving so persistent to break down? Because this is a conversation you and I for sure, Shona and I for sure, have had over several years now.
Yes, thank you for these questions. This trade finance gap is really key issues for emerging markets. And then both IFC and EBRD, we as MDBs, we serve emerging markets. So this is a critical issue that we have to work on. We see so many factors creating this trade finance gap. One is regulatory issues, legal and regulatory framework in emerging markets. The other is maybe the financial institutions, bank side, risk appetite. They don't have enough risk appetite, or maybe compliance requirements is so high that they are not able to provide trade finance as much as they can. The other aspect is maybe the exporters and importers side. They also face situations where they don't have enough collateral, or maybe they don't have enough credit histories to access to trade finance. We look forward to expand this discussion collaboration network to the private sector participants. So this is the issue that we are working on at this moment.
Thank you very much. So 3 key factors. Shona, do you agree, disagree, or are there additional factors? So regulatory framework, particularly in emerging and developing markets, financial institutions, i.e. bank and risk appetite, lack of collateral and credit history from an exporter's importer's perspective.
first of all, I agree with all of the above. But just in addition to that, I'd also like to maybe focus on, let's just say that this is not a uniform problem that goes across all of corporates and SMEs. This issue is far more concentrated, obviously, amongst smaller companies, particularly operating in high-risk markets, where the economies themselves are also underdeveloped. So what we call early transition countries, who perhaps have not yet developed the tools, the frameworks, the standards to be able to actually deliver the data that Makiko mentions in a form which is easily digestible and understandable by financial institutions, added on top of which a lot of the banks that we work with, again, in our developing markets themselves, perhaps are also lacking in some of the tools, maybe some of the more sophisticated structuring tools that could actually allow them to overcome some of these barriers around things like a lack of collaterals that Makiko mentioned. So a number of banks, when they think about collateral, they're thinking about hard collateral. So property, for example. And if we go to maybe some of the smaller, less developed countries in Central Asia or in sub-Saharan Africa even, how much collateral do these small trading companies actually even have available to offer? Whereas actually they're probably sitting on a whole pile of really good quality receivables, nice liquid receivables that could be pledged as collateral. But the banks in themselves still need to develop some of these product structures which would actually enable them to provide some of this lending. It's really interesting because the $2.5 trillion trade finance gap was exactly the same last year. Now, we would think global trade has been growing, basically grows almost every single year apart from the COVID years. So why hasn't the trade finance gap in itself actually grown also? And the answer to that may well be that it's finding a home elsewhere, that there's an increase in business-to-business, peer-to-peer lending through trade credit, the rise of platforms and non-bank lenders perhaps are taking up some of this space, or simply companies are just going out of business because they can't access financing. And to tackle this, there's a huge amount of work that the DFIs can actually provide through, let's say, the non-transactional side of what we do, which is equally as important to the transaction support that we all provide through our guarantees and our liquidity programs. And that's all around capacity building. So that's the building the knowledge, providing training, providing advisory, providing consultancy to our clients. So those could be directly to SMEs and corporates. So teaching them how to use trade finance tools, when to use trade finance tools, how to report, how to build a relationship with the bank so that those rejection rates that we see that are really high actually start to reduce, because they know how to approach a bank and how to ask for money and what sort of materials and what sort of data they need to provide. So there's a lot of work that can be done in that space. Then equally, there's as much capacity building that can be done with the banks, equipping the trade finance teams with the right knowledge to be able to go and even speak to their own risk departments to actually overcome some of the barriers that I think everybody in banking actually faces quite often, which is how do you explain trade to a risk officer, and how do you communicate the fact that this is a very low risk liquid asset, and therefore the lending parameters and the decision making around this isn't the same as if you're looking at a 5-year term loan. Being able to actually help our banks to understand how to communicate that and then how to put the right structures around it is a really important part of the work that we as DFIs do and are increasingly doing. So I think there are many ways in which we can tackle this from many, many different angles. The reasons as to why it exists, again, are multifaceted. So it's not something which can be solved with a silver bullet. Absolutely not. This is going to take a huge effort by all of industry and by all stakeholders and all players across trade finance and outside of the trade finance industry, because let's not forget, not all of trade sits inside trade finance.
So you've identified that fourth factor, which is that lack of products that emerging market and developing market banks tend not to have. And again, all of these four factors are compounded by a lack of capacity building or technical assistance, or effectively understanding the language of trade finance. And it's also compounded for SMEs in those early transition countries, as you put it. Makiko, we covered TF COP at one of its first meetings in Seville. And you, of course, IFC, of course, hosted the Washington TF COP on the sidelines of the autumn meetings of the World Bank. What was the general genesis of the last TF COP meeting, and what were some of the key conclusions and ideas that these workshops brought about?
So yes, IFC hosted last year's TF COP and also side event in Washington last month. So I think together with the Seville meeting, I think TF COP is trying to address these issues that mentioned by Shona and myself. So I think this is a kind of a network that tries to identify solutions to tackle this trade finance gap by 2040. And then they're also trying to find the tangible solutions to narrow this gap. So I understand that after this discussion from last year and also Seville and also side event last month, task forces are being created, and then private sector friends from banks or maybe fintechs or insurance, they try to come up with innovative solutions. One discussion we heard during this workshop was about the first loss structure that they were discussing. So I think I welcome this type of active discussions, active ideas, innovative ideas from the private sector friends. And then they try to come up with a solution that would be maybe implemented in the future. And then this idea of structured solutions, maybe not necessarily a first loss, but then the various ideas, various mechanisms that were discussed. I think it's really a precious network that we try to be innovative to present something new to the market so that it is more like a wake-up call for the market to think about outside of the box.
It's interesting because the whole point in TF COP, or the reason for its establishment, is we've tried lots of things in the past. The gap still persists, therefore we haven't solved it. So what can we do? So there were suggestions around the first loss structured solutions. I think there was even a sandbox idea at play. Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. Shona, what's the most effective role the multilaterals can play right now in crowding in private sector liquidity into markets that need it most?
Ultimately, this is about mobilization. So the role that the DFIs play, and this is not just purely in our trade finance programs, but this is right across the board in terms of all of the development work that we do whenever it comes to financing a project of any type, is our role essentially as the sort of, let's call it the anchor in the transaction. So whether that's as a guarantor that's providing credit risk mitigation, both the IFC program and the EBRD program and the ADB program, all of us, we provide these guarantees that sit in between borrowing banks and lending banks or issuing banks or confirming banks in our markets. So we essentially eliminate country risk and credit risk, allowing banks to freely transact with each other without any impact on their capital requirements for those transactions, because with our AAA ratings, essentially these are risk-free transactions equivalent to cash. So there's an incredibly important role that we play just by being in a transaction. We can pull in all of that extra credit appetite and lending because we're in there, they're actually providing guarantees. And our role as MDBs is counter-cyclical. So we are there when going gets tough, or we are there when the market is going through some sort of structural constraints. Our role is to be there to ease that situation and actually to keep money flowing and to keep risk appetite flowing. So it's all about how we play a part in, first of all, mitigating against all of that risk. We also share risk with each other. So we work on transactions where there may be one MDB in there, and we have risk share agreements with other IFIs that help us in some of the most challenging countries. And we also provide liquidity at very, I have to say, at very, very good rates. So because our cost of funds is low And therefore, we can also help to provide that liquidity in the market where perhaps it's dried up. Obviously, our role is then not to stay when things become really rosy. That's when we leave the market. That's when those markets graduate out of needing the support and are able to then go into the markets and borrow under their own names without any requirements. So our role is very transitional, and as it should be. So we're not there to compete, we're there to facilitate.
Makiko, are there any other IFC related structures within the trade and supply chain finance program that can effectively help bring more liquidity into markets that need it most? Because I guess insurance perhaps also has a role in this, right?
Sure. Shona already summarized the role of DFIs, MDBs quite well. IFC does the same thing. We do a funded and unfunded risk-sharing facilities, working also with other DFIs, IFIs as well. I think also I agree with Shona in terms of a counter-cyclical role. If possible, we tried to go to the high-risk countries where MDBs, DFS are needed. The good example is maybe Ukraine, that we decided to stay in the market and working together with EBRD, actually, and then also other partners like BII or DFC to stay, and MIGA as well, to stay in the market. This is a kind of a role that MDBs can play. We have insurance partners, as you mentioned. We have 14 insurance companies that partner in our global trade finance program. And then if needed, we work together with the insurance companies to share exposure so that as MDBs, we can go to frontier countries effectively. So this is how we are also trying to work with insurance partners. So I think mobilization is really key for us. This is a central theme at the World Bank Group as well, that we tried to mobilize private capital into emerging markets. This is our central role. It's not just maybe financial institutions, but then also insurance, and also using a structured product, we would be able to tap new investors so that we would be able to mobilize more capital into high-risk countries. Just to add maybe one more thing, Shana already mentioned about advisory services, technical assistance, capacity building. Yes, I think to close trade finance gap, especially for SMEs, we do provide this type of assistance, especially for SMEs, working together with WTO. So this is a WTO IFC's joint program that we facilitate those SME workshops. The recent ones, for example, held in Cote d'Ivoire, Rwanda, we are planning to do the same in other African countries. So I think not just work together with maybe regulators or maybe financial institutions, we are trying to expand our capacity building activities to see if we would be able to provide direct assistance to those exporters, importers. The last one is maybe the legal and the regulatory frameworks. EBRD is also very active in this area, but then IFC too, we also work together with the World Bank, and then we try to strengthen the laws and the regulations in certain countries, in emerging markets, so they would be able to maybe promote more trade finance, supply chain finance in the local markets. We think this is one of the maybe important roles of MDBs, DFIs that can contribute to the local markets.
Add another point there, just to Makiko's point, which is about along the capacity building and how we strengthen the institutions and the corporates and the SMEs that we work with, which is in the whole area of compliance. Now, this is, again, in all of our early transition countries, this is a big issue. And it also is one of the many drivers of the trade finance gap, whether or not the issuing banks in our countries are able to comply with all of the requirements of correspondent banks and confirming banks. So we see this as being particularly exacerbated in countries like Central Asia and the Caucasus, which have been very affected in a secondary way by the Ukraine-Russia war, which has heightened sanctions risk, for example, and then has resulted in a almost wholesale withdrawal in some cases, particularly in the small countries where the economics don't make sense for someone to go through all of the enhanced due diligence that's required to keep those trade lines open. Giving our banks and their clients the tools with which to be able to be more compliant is key. And that's a role that the IFIs, the DFIs play, is we bring consultants and trainers into those markets, into those clients of ours, and we give them the tools to be able to actually ensure that they themselves are more compliant. It's maybe not quite as sort of upfront there in terms of a solution, but it's underneath. It's actually really important that these institutions all have the right sort of economic governance and process governance to actually allow them to be able to be bankable by other counterparties.
Thanks, Shona. Makiko, is domestic SME financing still a problem?
Yes, I think this domestic leg is also important. This value chain of SMEs, which are maybe trying to connect to the global value chains. I think in the WTO study, if we increase 10% of access to domestic supply chain finance, it might be able to increase cross-border trade by 1%. So I think it is also important for us to work on the domestic supply chains among the SMEs so that we can potentially increase trade finance in the end. At IFC, we tried to work on this domestic supply chain. We started the supply chain finance program back in 2010, but then especially we are trying to work on the domestic supply chain since 2022. We did a quick one study in one country, and then it is great to find out that about 68% of domestic suppliers that we finance are actually SMEs. So yes, 68% sounds still maybe low. It's not 100%, but then it's good that our financing actually are going to those SMEs, domestic supply chains that need help in order for them to join these global value chains. We are trying to expand our domestic supply chains programs. We have included receivables discounting and pre-shipment this year. So we are trying to be very active in receivables discounting and pre-shipment, hopefully covering multiple regions. We are doing this type of financing only in a few regions, but then we are hoping to expand these activities.
Thank you very much, Makiko. Shona, we're talking about new solutions and ways forward, and we were with you at the TFP forum in Cairo just a few weeks ago. We heard lots about the momentum that digitalization has been gaining, but I think it's fair to say adoption is lagging, if anything, potentially even slowed down. What practical steps do you think MDBs can play to accelerate interoperability? That is the idea of systems talking to other systems, sharing data, sharing APIs to really promote the use of digital trade. So I think it's fair to our listeners to probably agree that digital trade is a great route forward, but adoption's lagging, and so is interoperability.
I wouldn't necessarily suggest that promoting interoperability is necessarily the responsibility of the MDBs. I think the ICC DSI is doing a fantastic job on that, and there are other bodies that are also, for example, FIATA or the World Customs Organization, WTO, who are themselves also very much promoting that interoperability at the sort of data level, or just ensuring that machines can read data that's coming from other parts of the world. So in other words, there's a standardization around that semantic layer, the sort of the meaning of what's actually carried inside the data, so they all understand each other. So I think there's a lot of great work that's going on in that space. What we can do is try and lean in and speak to regulators wherever and whenever possible to highlight to them the importance of this topic. Now, we're doing some really interesting work at EBRD around what we're calling our digital trade network, which is where we're bringing together what we would say is the physical side of the trade corridors together with the financial side of these trade corridors and the digitalization of all of them, to trying to bring all of it together, because we have a lot of work going on, as does IFC and the other MDBs, around infrastructure. So infrastructure build, so whether it's transport systems, ports, airports, but also the establishment of single customs windows, which ultimately is where that data is getting processed, and where is also where a lot of the efficiency gains can be made if customs can process goods arriving and actually get them cleared as fast as possible, because everything's able to be processed digitally, and that then flows through to the sort of making trade finance more efficient and the digitalization of the banks and their processes, again that can only happen if everything is in a digital form. As soon as you go back onto paper, you get stuck again. So what ultimately our vision is to try to get this sort of physical side, so the transport system supports the single customs windows, together with what's happening between traders, so importers and exporters, all of the documents that they're generating and that the suppliers of data into those trades. So whether it's certification bodies or whether it's their invoices, so making sure that they're actually using e-invoices and not paper invoices, and certainly not PDFs, or nothing wrong with PDFs, but it's not data that can necessarily be in a machine readable form unless it's gone through another transformation process, to the actual transport documents, things like bills of lading and ultimately promissory notes, bills of exchange, which get used in financing, trying to ensure that those are all then going to be acceptable, whether it's a bill of lading in a digital form, is that acceptable to customs even, or to a bank when it comes to actually releasing title and goods, because they may or may not recognize that as being an original document unless they've signed up to various rule books. So being able to try to get the adoption of the model laws on electronic transferable records, the well-known MLETR, to actually get that adopted wholesale across multiple countries is an imperative. There are, how many countries are we at now? Probably about 14, something like that globally. Unless we're just always going to be looking at trade between the UK and France and Singapore, we really need to get the other countries that are in our regions and that are our responsibilities to come up the curve. So we've been doing lots of work in Morocco, in Egypt, in Turkey. We are, together with ADB and IFC as well, looking at trying to get adoption in several of the Caucasus countries, looking at countries like Ukraine. There's a lot of work going on around all of the Commonwealth countries that's actually being led by the Commonwealth Secretariat, who I think they got agreement when we were in Namibia from all of the Commonwealth countries to actually adopt the MLETR into Commonwealth sort of common law. So it's happening more slowly than we would all like, but it is happening actually in chunks, if we put it that way. So if we get all of the Commonwealth countries to adopt it, and then we get all of the middle corridor countries within the EBRD region to adopt it, and then we get the LATAM countries to adopt it, and then IFC, you cover the whole world. So it's on you to get everybody else to adopt this. But we need these legal pieces, we need the physical pieces, we need customs, we need all of these different parties to an end-to-end trade transaction to actually come on board and all agree to be able to have the right data processing and machine readable formats in place so that we can get all of those gains.
So it's interesting because I guess the MDB role could be to align and ensure the legal frameworks for the digital adoption of trade documents can happen, can accelerate, and every country can be integrated.
So definitely the legal side, but also things like working with customs. So if we go in and develop customs in a country, making sure that when that single window is established, that actually the standards they're adopting are the same as everybody else's. Otherwise, you've got two customs entities that can't talk to each other.
Yeah. So going back to the start of the podcast, really introducing the concept of TFCOP, and we're publishing this podcast ahead of TFCOP. So really, Makiko, it's time for you to set some homework now, because we've got a bunch of banks, insurers, fintechs, public and private partners, probably all here to collaborate, probably with a joint objective of thinking about new innovative ways to close the gap. Where do you believe we need to focus our efforts most to address this gap collaboratively, and how can we unlock more capacity and capital?
That's really a good questions. If we, as MDBs, DFIs, talk to our partners like banks or maybe fintech companies or insurers, those bilateral talks have a different dynamics. I think maybe we would like to hear complaints from all of our partners. We would like to hear what they want for their Christmas gift, like wishful thinking type of ideas. We have a bilateral discussion with each individual partners. But then if you come together, I think there is another dynamics going on to co-design the common solutions for everybody. So I think this is a dynamics that we look forward to hearing from these TFCOP discussions on Friday, because if all of those parties meet each other together, then maybe they will have a different mindset. They will think about emerging markets, what they can do as a part of the maybe stakeholders. So maybe it's not just a Christmas gift, wishful thinking type of ideas, but we go beyond that we tried to invent, we tried to co-design the same more like infrastructure where everybody can participate, everybody can contribute. So we look forward to the discussions in the next meeting.
So if I heard that correctly, Makiko, you're all ears. Shona, what's your call to action?
I think we need to continue with this collaboration, with this blue sky thinking, that what is the art of the possible? And that should be possible. We've got a collective hive mind of the whole industry. Really, we should be able to think about approaching this differently so that we're not just looking at the same problem through the same lens, but actually we turn it upside down. And maybe we bring into our collaborative space people that come without all of the trade finance industry knowledge, and people who can look at it with really fresh ideas and just, as I say, turn it on its head and really try to innovate and think about how we solve this problem, and then take these ideas and test them in these sandboxes that TFCOP is setting up and really see if they've got legs, because the only way to really find out is to try it.
Shona, Makiko, thank you very much. It's clear that the trade finance gap is not a uniform problem, and that's why industry practitioners, banks, DFIs, insurers and fintechs will all be gathering in London at TFCOP this Friday to really look at new, fresh, blue sky thinking approaches to address the problem. That was Shona Tatchell at EBRD and Makiko Toyoda at IFC. Thank you very much for joining us, and we look forward to moving the conversation forward.
Thank you.
Thank you.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.